Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it is my pleasure to be your host for today's episode. In today's podcast, we'll be looking at what happened over May 2025, and we'll be discussing the outlook going forward. This podcast is being recorded on Wednesday, the 4th of June 2025, and joining me again today is our Chief Investment Officer, Rob Hogg. Hi, Rob.
Hi, Steve. How are you?
Welcome back again. Again, what a month. It's always unpredictable, as we said last month in markets, and that's true for this month as well. Could we start by you just briefly running through what happened to the markets over the month?
Yeah, no, for sure. And look, again, as we've seen most months this year, investors are really, in a sense, running from one side of the ship to the other. And look, a lot of that's down to Trump, to be fair. But I think last month, a reasonable amount of it was due to other stuff as well, all of which is impacted, to be fair, by the tariff announcements and so forth. So what we saw over the month of May was a pretty strong month for equities globally. The US market was up a little bit over 6%, so a very strong month. The Aussie market, so the broader ASX 300, that was up a little bit over 4%. Small caps did better than that. They were up almost 6%, so a very strong month. And we saw similar rates of return around the rest of the world as far as equity markets were concerned. So a pretty consistent story globally in May of higher equity markets. When we start looking at other asset classes, the story is a little bit different. If we look at bond markets, the two bond markets globally that moved quite a bit over the month were the US, and I think that's sort of related to what we saw in equities, with US equities so strong and bond yields rising there for some similar reasons. But the other standout really was Japan, where yields there on their 10-year bond rose by around 20 basis points. Now that's quite a bit when you're going from 1.3% to 1.5%. So that was Japan, the US. Here in Oz, the moves are not quite as dramatic. The 10-year bond was a little under 10 basis points. That's the 10-year. Shorter maturity bonds were pretty much unchanged here in Australia. And just looking at Europe, across the continent, and the UK for that matter, there were relatively small moves in bonds. Equities, big moves. US, Japanese bonds, big moves. Other bonds, not much of a move at all. And then currencies, look, they were remarkably unchanged. The Aussie moved from around 64 US cents exactly at the end of April to just 64.30 by the end. So a very small move, less than 0.5%. And the trade-weighted US dollar, which we all know has been where a lot of the action has been, what we've seen this year has been weakness in the US dollar against a lot of currencies. But during the month of May, the trade-weighted US dollar was pretty much unchanged. So a very intriguing sort of month, but clearly one marked by stronger equity markets.
And so perhaps if we don't talk about Japan often in these podcasts, can we talk a little bit about Japan just in last month? As you say, that 20 basis points change in bond yields is historically quite large for Japan. Why was that and what happened?
Look, very intriguing in the context of what's going on. Japanese bonds have now been selling off, so yields rising quite significantly for more than all of this calendar year to date. Indeed, if we go all the way back to around July, August of last year, when monetary policy started to change, you might remember there was a month last year that was very negative for equities, and a lot of that was due to the fact that the Bank of Japan was moving policy around and surprising investors with a tightening move. They've generally continued to move in that direction, albeit slowly. But I think what's happening here is that inflation expectations, which they've done so much to try and increase, have finally started to rise. So there's an element as well of that occurring. So changing policy settings and expectations of further changes, but also an increase in inflation expectations seems to be being reflected across the Japanese yield curve. So we've seen, as we're saying, some pretty significant moves, and last month wasn't the only month that we've seen those. We've seen several months of quite significant moves in the Japanese bond market. It's an interesting bond market. There's not many global investors in the Japanese market historically, but we've definitely started to see more investors taking note, because what happens in Japan can have a significant impact globally, and that's mainly because of the nature of portfolio flows, and that's particularly portfolio flows by Japanese investors offshore. But we're now getting to the point where those sorts of yields, 1.5% on a 10-year Japanese government bond or JGB, is now looking increasingly attractive to domestic Japanese investors. So that could start to see changes in the nature of Japanese portfolio flows globally.
Yeah, well, I guess they might bring money back offshore, right? And that could also have implications. Rob, I'm going to throw this word at you, and it sort of, for me, resonates. It's an old behavioural finance term that I'm sure you remember from your economics days. But habituation, it seems to me that the equity market is becoming more resilient, if you like, to the volatility of Trump's announcements. Is that a fair comment?
I think it is. One way, indeed, to think about it is habituation, where the market is now becoming a little more used to continual Trump-related tariff announcements. So after the shock of the Liberation Day announcements on the 2nd of April, which had a huge impact, as we remember, the ongoing toing and froing each time has had less and less effect, which I guess you'd sort of expect through time. But the other word that's actually taken on significant life during the month of May is taco. So this all comes from an interview given by, I can't remember his first name, but Mr. Scaramucci, who I think from memory spent a couple of weeks in the White House in the first Trump administration. He might have been Treasury Secretary. Anyway, he and Trump fell out very significantly during Trump's first term. But in this interview with the Financial Times, just in the last couple of weeks, he's coined this acronym, TACO, T-A-C-O, which stands for Trump Always Chickens Out. And I think there's an element of that as well in what we're starting to see. So it's part habituation, but I think it's part the market starting to think, well, maybe Taco does describe the way Trump tends to operate, coming out with big announcements, scaring people and then gradually watering that down. But look, I don't know that should give us an enormous amount of comfort, because it's not beyond the bounds of possibility that Trump's not terribly keen on this description of him, and that at some point in time he chooses to really push back on that. But anyway, for the month, I think one of the words of the month was taco.
Just on habituation then and the tariff side that you were referring to, there was a pause in the US-China tariff implementation. Can you just walk us through that?
Yeah, so that was announced around mid-month when the US and China together announced that their tariffs on each other would decline by a little more than 100 percentage points. So that's obviously pretty big. And having done that, that leaves an increase of only around 30 percentage points for US tariffs on China in 2025 and around 15 percentage points for China's tariffs on the US. So much, much lower, obviously, than the first sort of ambit claim. So maybe this is a case of taco. Anyway, these rates will be effective for 90 days. So we'll have to revisit all of this in the next 3 months, because the statement also said, well, implied, that after those 90 days, the rates on both would rise. Again, not back to where they were, but rise again. The statement that accompanied this announcement also noted that the US and China will establish ongoing dialogue on economic and trade relations, and that the two countries have worked towards some sort of rebalancing of trade. Well, look, talk is cheap. The reason they have the trade imbalance that they have is down to a whole lot of economic related reasons, and not quite that easy just to rebalance with the click of a finger. But anyway, mid-month that came out, and that did have quite a significant positive impact on the market. I think not only because of the size of the back down or the revision downwards, but I think also because it was pretty clear evidence. And maybe this is when Scaramucci decided to coin his taco term. It was evidence that there is certainly significant negotiation that can be done in regard to some of those April 2 announcements. So those two things together, I think, were important.
Yeah, absolutely. And I think the fact that they've done that, it's interesting, Rob, that they've also tried to have agreements. They have made an agreement with the UK. And so I guess it's becoming increasingly clear to markets that the worst case scenario of April 2 is not going to happen, that it's more just Trump using this as a negotiating tactic to try and extract better deals for the US, but they're not going to be anywhere near as bad as originally thought.
That is fair with most countries. I think some analysts point to Europe as being maybe a tougher nut to crack. So we'll need to see what they do there. But certainly the evidence so far, as you suggest, is in regard to the UK and China that the agreements that have been reached are quite different in magnitude and impact than one may have thought just looking at the announcements back on the 2nd of April.
And so the other thing that happened was the big, beautiful bill, the Triple B, that was passed in the House of Representatives, but wasn't exactly a resounding success.
No, yeah, but I guess one vote's all it takes, and indeed one vote was all it got, one extra vote. So it's passed through the House of Reps in the US Congress. So now there'll be a lot of toing and froing between the House and the Senate to negotiate the details. But look, I think here the important thing, and this is what I think the market's taken out of it, the bottom line, even after what will likely be potentially quite significant negotiation on the details between the houses in the Congress, the bottom line is that this will very likely be quite stimulatory, and it will lead to a fiscal expansion relative to current law, that is. Analysts expect that it'll actually be enacted come August, so we could well see potentially some impact from this in this current calendar year. And look, I think it's fair to say that the nature of the bill in its current guise anyway will, in all likelihood, have a positive impact on corporate cash flows in this year. So it's right in a sense, or sensible in a sense, that equities moved a little bit higher on the back of that, starting to discount some of the very likely positive impact.
Yeah, the issue, I guess, is you've now got quite high-profile critics of the bill, and probably no more high-profile than Musk. And I know this is in June, but what he said last night, actually, I was calling it a disgusting abomination. There's obviously going to be a lot of work that needs to be done because one vote, as you say, is not much, and therefore there's likely to be room for change, one would have thought, on this thing.
Yeah, I'm pretty sure you're right. And interesting that one thing that it seems Elon Musk will carry on from his days in the White House is the type of language and words that Trump uses as well. A disgusting abomination.
I know, it's incredible. So one of the things that surprised me during the month, and you and I have spoken about this for a couple of months, Rob, is that we've been waiting for the data to soften. And I'm talking specifically about the US. One of the key risks that we've spoken about over the past few months is that there is a risk that the US will head towards a recession, and therefore the soft data, which had been showing softness, if you like, in the outlook, we have been expecting that to be showing through in the hard data, but that's not actually the case. Is that correct? And if so, why do you think that is?
Yeah, as you say, it's been quite remarkable how rapidly and sharply a number of these sentiment indices have moved lower. And we're talking here really about this survey. These are survey-based measures, so they're sometimes described as soft data because they're not actual spending, they're not actual investment dollars, for example, they're sentiment surveys. And look, they do often, indeed probably most usually, have a bit of a leading nature to them, but it's not absolutely always the case. They're not an infallible guide to the future of what actually happens in the real economy. But anyway, we've had, beginning back, I think probably February it might have been, we started to see quite significant weakening in a number of consumer confidence surveys, and we started to see weakening in various corporate-related surveys as well. And so it was both the size of the falls and the very low levels to which some of these indices fell, so back to sort of COVID time levels, that is what was really leading investors to expect that this will inevitably have an effect on the real economy. And we were no different. And indeed that may well still occur and probably will to some extent. But to date, what we've seen is firstly, no real impact, no discernible impact on real economy data. And by that I mean things like employment, filings for unemployment claims, which if we remember were all expected to start rising significantly on the back of the whole Doge campaign run by Elon Musk. We haven't really seen much in the way of unemployment from that or any other source. Investment spending is still doing okay. It's not racing away, but neither is it collapsing, and it's certainly not doing what may have been expected given the sharp fall in some of these corporate sentiment surveys. And look, similarly with household surveys, even though household confidence has fallen very sharply, we haven't really seen a significant falling away in things like retail sales. In fact, the retail sales report that was released during May, which pertained to April, actually surprised on the upside. So that's one thing. We haven't yet seen the flow through to real economy data as it's described. So like actual spending, actual hiring, the resilience has been there. But the other thing that happened during the month was that the so-called soft data surveys, which had fallen, as I was saying, to very low levels, have actually started to recover somewhat. Yeah. And clearly, according to the analysts that put these surveys together, the talk of the tariff freeze and so forth, that did have a positive impact. So trade policy, the wind back in some of the trade policies does seem to have had an impact. But I think it's probably also due to the fact that having fallen so sharply, so quickly, it wouldn't really take a hell of a lot for things to turn around a little bit. And I guess that's the other thing. They've turned around a little bit. They've certainly not rebounded to where they were pre this year, but they have nevertheless rebounded. And as I say, the underlying macro data remains quite resilient. But of course, the market's moved in reaction to this. This is one of the reasons, perhaps this is the most important reason, why equity markets performed so well during the month, the underlying resiliency. So the markets have now really bought in, certainly partially, maybe a little bit more than partially, into this ongoing resilience of the US economy. So if anything, we're now sort of facing the potential risk that if we do start to get any cracks in this resiliency, we may well see equity markets move lower as a consequence of them having priced in resiliency, effectively in earnings, resiliency in the economy. That may not be what occurs. And you have to think that all of the disruptions that we've seen in the US, in manufacturing, even in the services sector, this cannot be unwound just because the level of tariffs has been wound back somewhat. In a sense, that the egg has been cracked, the omellette's been made. I think all we can say so far is that the impact of the volatility and uncertainty has not yet presented itself clearly or as significantly as some were fearing in the real economy data. So we still have to wait and see, and this must be seen in the context of what markets have done. They've recovered a lot. Equity markets have recovered a lot.
They're not far from their all-time highs, right?
So, no, that's exactly right.
In both Australia and, well, Australia kind of, as we've spoken about before, Australia is a little bit protected from the volatility of tariffs, but certainly the US, I can't actually remember what the exact all-time high is, but we can't be far away from it in terms of the S&P. So it is a bit of a concern. We'll talk about the market outlook in a sec, Rob, but with the hard data such as retail sales, the question I just wanted to ask you is, do you think the retail sales data in April might have been affected by the pull forward of consumption ahead of the tariff rise? Is that, or would they have already occurred?
The month of March saw an enormous rise in retail sales, up 1.7%. So that was really the pull forward. But what was significant about April was the fact that even after that huge increase in March, the total value of sales moved fractionally higher again. And that's what makes it such a powerful outcome, that a small positive in April following such a huge positive in March, that 1.7% gain. So that is the significance. I think, yes, as you say, it does reflect the bring forward, but it built on the back of an extremely strong month, which very likely was absolutely all about bring forward. And we've seen the same thing in trade data as well. You might recall that when the first quarter GDP numbers came out in the United States, there was a huge negative contributed by a very significant increase in import volumes, because in a national account sense, imports are a negative as far as GDP is concerned, because they reflect spending on offshore manufactured goods and services. So that was one of the reasons, as measured by GDP, why growth was so incredibly weak in the March quarter, and there was a huge increase in imports. But then we see, come the month of April, there was a very significant decline in the total value of imports in the month of April compared with the month of March. And that's impacted by this timing mismatch, the bring forward of imports. So look, all of this does make it a little more difficult than usual to try and get a sense of the true underlying pace of the US economy. These movements around as consumers and corporates for that matter try and beat the tariffs and so on, import earlier, spend earlier and so on. So it's still a little bit murky.
Yes.
A little bit murky because of that as well.
One of the things that's murky as well, or a little bit surprising, is inflation. I think it's fair to say that most people are expecting that inflation would rise, or at least given the tariffs, but that's not actually the case, is it? What happened in terms of the inflation index, and what does that mean for the US central bank, the Fed?
Yeah, well, look, as you say, inflation, a bit like the resilience in the real economy data, inflation has surprised a lot of investors as well. Exactly as you said, the outcomes there seem to be, if anything, a little bit lower, a little bit better than expected. Now, the Fed, the US Central Bank, has a favourite sort of or preferred measure of inflation, that being the core private consumption expenditure deflator, or PCE deflator. And in this context, deflator just means that is the index that they use to change nominal or just current dollar data into volume type data. So that's used usually in a national accounts perspective. So it's deflating to get a real sort of measure. This is the deflator or the index they use to do that, just by the by. But this is a very broad measure of private consumption spending. That's why it gets the focus. It's got a much broader range of goods and services in it compared to the CPI, for example, hence the Fed's focus. Anyway, bottom line, the most recent reading there was an increase on the month of just 0.1% in April. And in fact, that was the second consecutive month of such a small increase. And that has seen the annual rate of growth, or the year-on-year change, continue to decelerate, so moving in the right direction. So all of this makes it a little bit easier for the Fed to continue cutting rates, because we've seen over the last probably 2 months, more and more of the voting members of the Federal Open Market Committee, or FOMC, more and more of them have been talking about, understandably, the incredible uncertainty of tariffs, what's it going to mean for inflation, the economy, and so on, and wanting to see more clarity on that before they perhaps move to lower rates again. We're now starting to get a little more clarity, and the news so far is really pretty good. If we were to continue.
Yeah, and that's probably part of the reason why the equity market has become a little bit more sanguine, right? A lot more relaxed.
Yeah.
So that is a nice segue, to use a word that I haven't used for a while, to Australia in terms of rate cuts. The RBA cut rates, and you predicted that last month, but they also discussed a larger cut, didn't they?
Yeah, and that was the most significant thing. Look, the market was really almost unanimous in expecting a rate cut, so it really wasn't a surprise on the day. So this is back on May the 20th. But I think what was a bit surprising was the fact that a rate cut of more than 0.25% was discussed by the new policy-making board. And in fact, the minutes have only actually just come out. I think the minutes of that meeting have just come out yesterday. And that makes clear that the policy board discussed 3 potential policy outcomes, one being no change, one being the 25 basis point cut that they did make, but another being the 0.5 percentage point cut. And that, as you can imagine, has been viewed quite positively and bullishly by the shorter end of the yield curve. And that, by virtue of being discussed, has, as a consequence, seen the market coalesce around an expectation that the next RBA meeting will likely see another 25 basis point cut. Now, interestingly, the minutes in talking about why the 25 basis point cut was ultimately what they decided on, they spoke to having a preference to moving predictably and cautiously in removing restrictiveness. And I think that's completely consistent with what, you generally want a central bank to be doing, moving as predictably as possible and cautiously, particularly given all of the uncertainty. And that may well be how this policy cycle turns out.
So what's the market building in now, Rob, in terms of the next, say, 12 months, in terms of RBA cuts?
If we look at current market pricing in futures markets, by December, the market's looking for a total of 50 basis points. So that's a couple of rate cuts, or a couple of 25 basis point rate cuts. And then come March next year, another 25 basis points. So over the next, over through till March next year, 75 basis points, through to December this year, 50 basis points. That's not a hell of a lot changed over the last couple of months, but that's a reasonably smooth, if we look at the shape of the forward curve, there's a reasonably smooth adjustment lower in rates that is seen. And that, I think, is consistent with what the RBA said about moving predictably and cautiously.
So does that mean inflation's under control from your perspective in Australia?
So, as you know, we now get monthly and quarterly CPI reads, and the most recent monthly CPI, that being for April, showed that inflation was running at around 2.4% in annual terms. So that's pretty much right in the middle of the RBA's band. And there's really nothing to suggest that inflation pressures are going to imminently start increasing. If we look at things like the currency, the Aussies rebounded, oil prices are lower, economic activity, whilst it's fractionally better in some cases, it's not rocketing off, and wage outcomes are generally continuing to ease in the rate of increase. So all of that together does tend to suggest that, if anything, the balance is towards lower inflation, so further disinflation. You'd generally expect that would be consistent with further rate cuts by the RBA. That and the fact that the cash rate is still close to 4%, it's less than 4% now, but close. So the cash rate's still at a relatively high level and higher than neutral. So all of those elements together, including the current level of the policy rate, suggests that the most likely outcome is further rate cuts.
And I guess one bit of data that is slightly concerning from an economy perspective is retail sales was softer, quite a bit softer than expected, wasn't it?
Yeah, yes it was. And look, also today we had the national accounts out and they were very weak. They were very weak and indeed showed another contraction in growth in GDP on a so-called per capita basis. And I think indeed over the year, a contraction in GDP on a per capita basis. That is extremely rare. I think you'd only see those numbers in the midst of a very significant recession. So now, to be fair, there were swings and roundabouts in the accounts, as there always are. Government spending was much, much weaker in the most recent quarter. And of course, that had been a huge and significant underpinning of growth over the last probably 6 or 7 quarters. So a bit of a reversal there, and a number of weather events as well. But through all of that, the underlying trend in the economy here is still relatively soft. So nothing in those numbers to suggest that the RBA can't be cutting rates.
So despite that, the local equity market had a good month, as you said right up front, following on from the US as well. Do you want to just go through a little bit more detail, just what the market did?
Yeah, so look, as we did say right at the top, the broader market returned more than 4%. And smaller companies performed even better than that. So that's a reasonably good sort of cyclical indicator. But look, in the month, positive performances were broadly based. So that's a pretty positive thing to see across sectors and individual stocks. And now, since the April 7 lows, just looking at the ASX 200 price index, that's rallied more than 15%. So that's a pretty significant rebound from those lows on April 7. And look, that's one of the reasons why we're again a little bit more cautious, because a lot of that, almost all of that, has in fact come on the back of higher multiples rather than earnings upgrades. And that, of course, starting from a position where multiple on the market was already at a pretty high level. The market certainly is not cheap and became in fact more expensive. Look, financials are still making a huge contribution, and CBA continues to make an outsized contribution on a month-to-month basis, and absolutely since the April 7 lows, and really for quite some months now. But look, over the recovery period, materials have done relatively well as well, as you'd sort of expect as growth expectations come back from very low levels to slightly less low levels, if I can put it that way. And as you'd also expect, the other side of the coin is about the defensives. They've been positive, they've made a positive contribution since the lows, but they've not been anywhere near as powerful in their contributions as the financials and the materials and so on.
Yeah, and it's interesting, Rob, you spoke about CBA, and it would be interesting to know just exactly how much it's contributed to the total return of the market over the past 12 months, but it must be huge. I was looking at a chart the other day, And the price to book ratio of CBA compared to any other bank in the world is just, it's like it's a different sector. And I'm not asking for an answer here because I don't think anyone's really got the answer other than just sheer demand for a safe stock. But it's just extraordinary how highly priced it is relative to other financials.
Yeah, look, it is. It's always been a pretty expensive bank on global comparisons, but where it is now is just a huge step change from that. And look, there's a whole lot of theories as to why this is ongoing. Some of it, I think, might be due to the nature of the shareholding base, that being a lot of retail holders who are probably reluctant to sell it because of the capital gains sort of implications. Some of it might be due to the type of flows we get into indexed sort of products. Some of it, there's lots of stories about the weighting of some of the very, very big funds into the banks increasing, and CBA is the largest, sort of benefiting significantly from that. And look, more recently, perhaps we have seen increased global flows, and that's really been the case with the US. We haven't spoken about it in this episode, but we've spoken about it before. Really, all of the policy change and policy uncertainty in the US and just the general winding back, really, of the nature of the governance structure of the US government and regulatory bodies and other associated government institutions. All of that does seem quite genuinely to have led to some capital moving out of the US, and we sort of judge that by looking at the currency and how that's softened. And that's moved back out of the US, and some of it's very likely coming to Australia. So that may well be an element as well. And of course, CBA, biggest stock in the market. It would be unusual if it weren't a beneficiary of at least some of that. So look, as with all of these types of things, I think it's a little bit of a whole lot of different things, but it's all just come together presently and just push the stock up to higher and higher record closes.
Amazing. So, Rob, one final question before we get to the outlook. There's been a lot of press recently about the $3 million superannuation tax, and various parties, obviously interested parties, are giving their own opinions, all of which are completely different to each other. I think it's going to be a topic that we'll talk about in the next few episodes, but have you got a sort of a headline comment at this stage as to where we are?
Yeah, well, look, it's still a little bit uncertain as to how exactly it'll pan out, but the government does seem, just judging by what we see in the paper, to be now starting to contemplate potential indexation, and 3 million does seem to be the amount, rather than 2, as some other political parties have wanted to consider. So it is leading to a lot of thinking about what those investors, those superannuants who are affected, may well start to do. So there's all manner of talk about various different strategies to place one in the best potential sort of position.
The issue I've got, which we can talk about next time, is that these sort of changes lead to unintended consequences where people seek to change their superannuation strategy as a result. And you know, with untaxed gains, it's not clear what's going to happen there, but one would expect that there'll be widespread transferal of assets into other vehicles. So it's going to be interesting to see how it goes, but more on that in the next couple of months. So, Rob, just wrapping up, do you think things have changed in terms of our outlook? I mean, we have been cautious. The market has risen, and I think it's risen probably in spite of the consensus of caution. And where do you think we go from here?
Yeah. So look, as we've been talking about in this podcast, the reasons I think for the very, very stellar performances globally, and certainly in Australia with equities, really come down to those elements of, tariff-related stuff, the pause there, US, China, and the reduction. There's that. But I think this whole resiliency thing has been possibly the most important. So we're sort of back where we've been the last several months, that it does seem likely there will be some effect on the real economy from all the tariff-related changes and associated uncertainty. We have not yet started to see that, and I think that led to what you might describe as a relief rally. But the uncertainty remains, and it's still, I think, a little bit too early to heave a sigh of relief and say that the worst is over. Perhaps, as we were saying earlier, Trump decides that he doesn't want to be described as a taco. Perhaps that may be what happens. Perhaps we do start to see clearer signs of an impact on the real economy of the uncertainty. Perhaps when Trump does start negotiating with the Europeans, that doesn't quite go as swimmingly. as it has with other countries and regions. But look, I think in a sense what we saw in May was quite a fair and reasonable response by the markets to what surprised investors, and that is the resilience of the US economy in the face of all this uncertainty and the disruptions that we know are already occurring across the US economy. Markets are back near record highs, and absolutely they are, but the world is not exactly the same as it was when those record highs were reached back in Feb, for example, in the United States. Things have changed. We were all very concerned with the April 2 announcements. A lot of them have been wound back. So it's only natural that after markets plummeted or sharply corrected, they've then rebounded when the impact's not come through, the negative impact's not come through as quickly or as sharply as expected. But perhaps we're running from one side of the boat to the other, perhaps we've run a little bit again to one side, the overly optimistic side, and perhaps when we're sitting down doing this in another month's time, it might be the case that some of the elements that have positively surprised investors in May have lost some of their momentum in June, but we'll have to wait and see.
We will. But talking about momentum, it's really great to see from our perspective that small companies in Australia have started to really perform well. And just looking at the returns that our small companies funds have eked out over the past 12 months, they're both, the Opportunities Fund and the Small Companies Fund are both above 20%. So for the rolling 12 months, it's quite clear that opportunities are starting again in small companies. Is a fair comment?
Yeah, no, that's absolutely right. We're starting to see a little more liquidity and a little more capital market related activity as well. And that's really what you need to see for this to have longevity. And that does seem to be falling into place.
Well, that's good news. Well, Rob, thank you very much, as always, for your insights. I think it's fair to say that volatility, again, is what we're expecting. And as you say, I think that the question we all need to face is there's a lot of good news baked into the market. So, perhaps it means that the good news stops and maybe what happens to the market in that case. So we're not calling, as we weren't calling last month, we're not calling a bear market. We're just calling a continuation of this sort of volatility. So again, that's good for us as active managers. So Rob, thank you very much for your time. That brings us to the end of today's podcast. We looked at what happened in May. We then looked at what it means for investors going forward. As we said last month, it's unpredictability and volatility, the two words, and now TACO as well is another word. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcasts from. Please do let us know if you have any questions or comments about what we're doing. And until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not constitute financial advice and assumes a certain level of knowledge. It's general information only and does not take into account the investment objectives, financial situation, or any needs of any person, and should not be considered a recommendation.